Keep in mind, another reminder, keep in mind, although sometimes it looks like magic, it is support and resistance. It is not magic. And this is very important to remember. I need you all to keep this in mind. Keep it in your mind. Sometimes it looks like magic. We have just seen a few examples where the price moved after an unbelievable touch with unbelievable accuracy away from the Fibonacci level. But of course, it does not happen all the time. So you need to keep in mind that it is support and resistance. We are not magicians here. We are market analysts. And sometimes we're right, sometimes we are wrong. Good analysts get 75, 80% right of the time. And that's more than enough for anybody to make a living out of this market. We should treat these levels like we treat any other support or resistance and estimate the chances of them holding or breaking in the same way we do with other support and resistance levels. How we do that? Okay, we use the power of technical confirmation. Technical analysis is a wide field. We have a lot of tools and we should use these tools. We should never use just one tool and make a decision based on one single tool. We need to use them all together and we need to learn how to read if they confirm or not. When they confirm, we have seen, for example, during the analysis hour, a fantastic setup on Bitcoin. And they are confirming each other, these technical tools. That's why I believe strongly that the Bitcoin will rise. But of course, sometimes it does not. However, we have a good percentage to lay on when they are confirming. 70, 80% of the time, when we get such a setup, the market moves in our direction. So we should use the power of technical confirmation to our favor when the price is very close to these levels. So what other technical tools can we use? First of all, previous tops and bottoms are very important. When the Fibonacci level is very close to a previous top or bottom, that doubles its importance. And you know, that can help very much in this level surviving. Okay, we also have trend lines, and I have trend lines before and after. I will explain. Trend lines before, meaning before the price moves away from the Fibonacci or retracement level. If we have a trend line around that area, that also adds to the importance of this level. Overbought and oversold readings definitely help. If, for example, if we reach the 38% level and we are still not in the oversold and the price keeps moving to the downside, then it might not be the right time to get in. Let's wait for the 50% and see if at the 50%, the RSI, for example, is in the oversold area. If yes, that will help us a lot in making the decision. If not, we wait for the next retracement level. Also, we have candles. Candles can be very helpful, but they do not help until the price starts moving away from the retracement level. So it's a late help, you know. Once the price starts moving away, then we check the candles. Okay, is this a strong candle? We have touched Fibonacci 61.8 and we started moving in the direction of the main trend. Now let's see what kind of candle do we have after the hour closes. Is this a strong candle? Does it support this idea or not? That's usually very helpful in determining the chances of a retracement level surviving or being broken. We also have the trend lines after. And what do I mean by that? After we touch the retracement level, the price starts moving away from it. Now, if we break a trend line that confirms this direction, that would be amazing. And finally, we have Elliott wave counts. Sometimes the price drops in a corrective ABC, for example, and C seems to terminate at one of these retracement levels. That would be a great confirmation that this specific level could survive and then we get in the market at this exact level. So it's always a great idea to combine your technical tools together and to try to find a confirmation regarding them. Okay, now after explaining all these ideas, I want to show you some examples. And as I told you in the past few days, I always pick fresh examples out of the oven for you. I look at the charts, I spend more time on the charts trying to find examples that are recent, you know, August, July, something like that, late June, but I will not show you an example from last year, for example. Okay, let us start with our examples. It's a bit hot here, so I had to open the window before talking about the examples. And I hope that there is no noise coming from outside interrupting this presentation. Okay, guys. So, the first example comes from the pound against the dollar, the cable, hourly chart. And this is a very recent chart from late June. As you can see, the price started dropping from around just below the 28 mark, 128, and we dropped until around 26.60. From there, we started correcting. Just when the price starts rising here, we should calculate the retracement levels. I will not be focusing on other levels than the 61%, 50%, 38%. Okay, I have a comment from Jack. Is Elliott wave even applicable? Of course it is, but you know, sometimes the count is not very clear, and when the count is not very clear, my advice to you is just don't use it. When the count is clear, go for it, trust it, and use it as a great tool. But sometimes the count is so messy that you don't know what wave you are in. In such occasions, just forget about it. You know, just use it when it's clear. And your question reminded me of the saying that if you put 10 Elliotticians in one room, they will come out to you with 11 wave counts. And that is true, of course, because, you know, counting waves is subjective. You see, for example, a 1, 2, and you are waiting for the third wave. I see an AB, and I wait for a C wave, for example. So, of course, when counting the waves differently, then our trades will be different. And that's why your question is very important. Is Elliott wave even applicable? Of course it is, but remember this, and remember it very well. When the wave count is clear to you, go for it. When the wave count is not clear and you don't have confidence about it, just forget about it and don't use it, because anything can happen when the wave count is not clear. It can go your way, it can go against your way for hundreds of pips, because that's what a messy situation is. It can go up or down, and we don't want to use that. We only use it if we see a clear wave count. Okay, buddy? Thank you for your question. Okay, so the first example I want to show you that sometimes the correction stops at more than one retracement level, and this happens a lot. After this drop, you can see that the first attempt almost touched the 38% level, but we did not continue moving higher from there, went down a little bit, and then went higher again and touched the 50% level with unbelievable accuracy, dropped again, and still, even, of course, if you sold here, you would be very excited and thinking about a huge drop. You see the price dropped 50, 60 pips, and that's it. Well, and then it moves higher again. This is some kind of surprise if you are sold here. What to do? Shall I close my position with a small profit or wait for it? Shall I place the stop above the 61% level? That is probably the best thing to do. Or, of course, if you have moved your stop and out of these 60 pips, let's say you took 30, 40, that's great. You have nothing to be sad about. Enjoy your profit. So sometimes it stops at the first, the second, the third, one or two or three of these levels before the big move comes. So when I see the 38 touched, the 50% touched, and the 62% touched, and then the price starts falling, this could be the big thing, as you can see here. All right, so we have a good entry here, a better entry here, and the best entry here. Okay, how do we determine which level we should short at? I was just saying that using other technical tools can be very helpful, and this is indeed one of the cases where using a technical tool, another technical tool, is helpful. Let's see what happens here when the price reaches the 38% level. One look at the RSI shows that we still have some room to rise higher. Okay, the RSI just moved out of the oversold area, but we have moved for a small part of the distance between the oversold and overbought. So yeah, it reached the 38% level, but what if the RSI keeps going higher? Then it will reach the 50, for example, okay? So here I would probably say, no, wait. Let's wait. It will get to higher retracement levels. Okay, and that happens. If we did not sell here, that happens, and the price starts rising again, we touch the 50%. We run fast to our RSI indicator and ask, RSI, please tell me what will happen next. The RSI here, it touches the overbought area. It touches the 70% level, and that's good enough, of course. If it goes above the 70% level, then changes direction, that is the best thing. But if it touches the 70 and start falling again, that's good enough. So no one at all can blame you for shorting here. There is nothing wrong with shorting here. This is a better entry than this, supported by the RSI. Even if the price moves higher, you did nothing wrong here. You sold when the RSI was giving you the indication to sell, and the 50% level, which is talked about by almost everybody, is touched with great accuracy. So even if the price moves higher from here, you did nothing wrong, but the price, to our advantage, moves to the downside, and we make money on shorting from the 50% level, and that is great. However, this is not the big move, so the price starts rising again. Maybe we can book some profit here if we are lucky. If we are not lucky, we will be holding on to our position without closing it on any kind of profit. And when we see it touch the 61% level, we see that the RSI is now in the overbought area, and just when it starts changing direction, that is the best entry in this setup. So we have a good entry here, not supported by the RSI. That's why it's only a good entry, because it's only a touch at the Fibonacci level. It's not supported by the RSI. We have a better entry here because it is sort of supported by the RSI. It's not in the overbought area. It touched the border of the overbought area before turning lower, and we have the best entry here. Why is that? It's not because the price dropped here, because when we are here, we don't know if the price will drop or not. It is the best entry simply because the RSI is in the overbought area and it started changing direction to the downside. This is what we want. When the price starts falling, the RSI starts changing direction, and we can take a short, for example, anywhere inside this red candle. If we did not sell exactly at the Fibonacci level, which is justifiable, of course. If we do not do that, we want to wait for a weakness signal. That is also a great thing to do. That is what professional people do. And when the price starts falling down, the red candle confirms the weakness. We can sell anywhere in this candle or at the close of this candle. In all cases, we are making an excellent profit. Projac, how do I get 1,000 pip per month? Okay, bro, we have talked about this. And one of the examples I showed you was the crude oil example, turning at a Fibonacci level, made 600 pips in 1 week. And another example, another very interesting example that we are currently witnessing is the gold example. I have talked about this almost every day. Gold is an instrument that is very sensitive to changes in the rates on the dollar, the interest rates on the dollar. And when the Fed cuts rates, then it is only logical to expect gold to shine and to go higher and higher and higher. And this has happened. We were on the first day of the month. If you have been following the chart, Mr. Jack, you would see the gold trading around 1400, and now we are trading above 1500. That in itself, of course, what day are we on the month? It's the 8th day. That in itself is more than 1,000 pips. So you have to look for these opportunities. The next question is, of course, how do I spot these opportunities? For gold, it was more than a technical issue. It's not on the charts. It was the rate cut issue that gave gold this kind of power. But of course, we saw many setups on the charts during this week that can provide us with amazing opportunities to make 100 pips here, 100 pips there, and adding them together. Well, definitely on a good month, of course, you're going to make more than 1,000 pips if you know how to spot these opportunities. For example, shorting here, this was late June, maybe 29th or something like that. We have a Fibonacci situation here, a great shorting setup because RSI supports it, and then the candles, just on the first candle we had support from the candles as well, and here after breaking below the moving average we have support of the moving average as well. So we have many factors pointing lower. A good position, a good short position here would have been making more than 100 pips here in a matter of 2 or 3 days. And you should always, if you are interested in 1,000 pips a month, you should always look for opportunities like this to make at least 50 pips per trade. And if you aim for the 100, that's even better. How can you spot these opportunities? Of course, using technical analysis. That it's obvious, I think, how much I love technical analysis. If it hadn't done so much to me, I would not be so enthusiastic about it. So my advice to you, you want your 1,000 pips a month, you can get your 1,000 pips a month. Remember what Warren Buffett said. He said, I never doubted that I will be rich. He said so because he just had this goal in front of his eyes and wanted to achieve it. How you have this goal in front of your eyes? You want 1,000 pips a month. How do you achieve that? Well, you are here with us trying to learn something new. That is what you should do all the time. You should attend webinars, videocasts, read books, and talk to people with more experience. Have a mentor, for example, someone who's been in the market for more than 10 years, trying to help you, and that's the way you do it. So it is possible, but of course you are not going to get your 1,000 pips by watching kittens on YouTube. You should spend your time more wisely. Learn, always learn. One of the habits of the highly successful traders, which they all agree on, is that they read every day.